I want to say thank you to Maxim for hosting me here today. I want to say thank you to everyone at the European University. This is in fact the 10th anniversary, the decennial of Vassar College's program here at the European University. And so I want to take just a moment out to pay tribute to the leadership and the vision of my colleague Nikolai Fertic, who has developed this program and it's thrived under his stewardship. I should also give a nod to my wife, Susan Carell, who is also here, who's the junior year abroad lady at Vassar College, and she's had a lot to do with this program as well. Susan and I haven't been in St. Petersburg, for a long time. I'm trying to remember what it was called the last time I was here, and it might well have been called Leningrad. But we're happy to be back in this beautiful city and here in this wonderful institution. And I have to say, Vassar's got some pretty fancy rooms, but I've never taught in a room as fancy as this one. Maxim's been kind enough to give you a little bit of my background. I came to Columbia to do a one-year MA, such is life, in 1972, and I ended up staying and I ended up writing my dissertation under this man, Bill Vickery, who went on, who was awarded for his life's work the Nobel Prize. Just as a side note, he was the shortest ever winner of the Nobel Prize. He was awarded the Nobel Prize and actually died 3 days later, so he never managed to collect his Nobel Prize. But he was a great influence on my life. He was a great economist in a lot of different areas. And for his dissertation, which he finished during the Second World War and published immediately after the Second World War, he wrote a dissertation called The Agenda for Progressive Taxation. And in it, he proposed about 21 ideas for making the tax system more progressive. Michael Boskin of Stanford has pointed out that the two most eye-catching of these were lifetime cumulative averaging, a scheme whereby you were taxed not on what you earned in any particular year, but what you earned over your whole life. And he did a lot of work as well on inheritance taxes, what is known in the trade as decreasing power succession taxes. He also thought, and this struck me again as I was writing this, he was very convinced that you should tax people not on what they earned, but what they spent, which I thought is an interesting idea, and one with the growing greenness of economics is an idea that whose time might well have come again. In other words, you shouldn't get taxed on your income, but on the amount of resources that you actually consume, was a driving force in his work. But anyway, during the presidential campaign of 2012, the Republican candidate Mitt Romney, after a lot of pressure, was required to reveal his tax statement. And in it, he revealed that he paid tax at about an average rate of about 13% and a marginal rate of about 10%. 13% will, as we'll see, to Russians seem to be pretty much a fair rate of tax. But to Americans, it's a very low rate of income tax. I asked Susan to get our taxes out, and I realized that I was paying federal tax at a marginal rate of about 36% and an average rate of about 23%, which was a hell of a lot more than Mitt Romney was paying. So this set me thinking. I thought that, I came into this world believing in progressive taxation. I worked under a man who wanted very much to promote progressive taxation. So what's happened in the meantime? Why have we come to this position where extraordinarily wealthy people like Mitt Romney will pay very, very little of their income in taxes? So I tried to start work on this. I got a real kind of assist in this because, as you will, as the economists in the room will be aware, that the must-read economics book of the year has been Thomas Piketty's Capital in the 21st Century. I think it actually qualifies for the most talked about, least actually read book of the year. But certainly everybody likes to be seen with it and talk about it. But anyway, he concludes, I found out by flicking to the end anyway, was that he's very much in favor of a progressive and global tax on wealth. Exactly how that might be implemented, we might want to talk a little bit later in this talk. For those of you, particularly my VASA students over here, one of whom has actually taken an economics course from me, but I'm not going to hold a responsibility for anything that she might have or not have learned in this course. It's actually worth having a quick description of what we mean by progressive. A progressive tax is a tax on which the average rate of taxation goes up as your income goes up. So actually, even the present Russian income taxation system, the personal income tax in Russia, which is this, it actually qualifies to be progressive. I'm talking here about the dotted line because Russia, 12, 13 years ago, went to a flat tax system. So the tax system that the Russians left in 2001 was in fact the solid line there, and it was replaced by the dashed line where you don't pay any tax less on an income less than of 4,800 rubles, and you pay a flat rate of 13%. Because of that set aside, you don't pay any tax less than 4,800. Technically, this is a progressive tax, but a more progressive tax system is this one. This is the current United States tax system, where you see it goes up in steps of varying magnitudes and ends up somewhere around 35%. But successive slices of income being taxed at a higher level. This tells you something about how taxes have moved over the last century. The Americans didn't have an income tax until 1910. The first income tax actually was in Britain much earlier. It was called at the time the tax that beat Napoleon. You Russians thought that Kutuzov beat Napoleon. No, it was the income tax. This has been the history of the income tax in the United States. You'll see during the First World War, it rose to very, very high marginal rates, 70%. It then collapsed. The rates fell down to about 25% in the 1930s. After the beginning of the Roosevelt institution of Social Security in the United States, the tax rate rose again. And it stayed up there until the mid-1960s, when it began to come down, and it fell most of all in the 1980s under Ronald Reagan. And now we end up in this, where the marginal tax rate is usually somewhere around 35%. But notice, back in the high days of redistributive taxation, wealth was being taxed, income was being taxed at about 90%, which most people felt was a rate in which you could begin to talk about serious disincentive effects. And that's always been one of the worries, okay? I just reflect on that. That's one of my funny slides about to come up. But the interesting thing, when I looked at this work, and I thought, well, if I want to talk about progressive taxation, I wonder what it is that Vickery himself said as a justification for progressive taxation. And in fact, he says absolutely nothing. And what's interesting about that is that everybody of all social classes, of all milieu at that time, felt that taxation should be progressive. It was one of those universally accepted truths about life. And you'll see it in lots of things. You'll even see it in the literature of the era. I don't know, if any of you have read Evil in War's Brideshead Revisited, you will. It can be interpreted in some ways as a very economic document, because it's a sort of funeral service for the great and expansive high consumption life that could have been financed in an era before aggressive progressive taxation and high estate duties. And Brideshead Revisited is one of those things where he's coming to the conclusion that the happy and wonderful days of the grand British country house were gone, killed forever by socialism, National Health Service, and estate duties. I throw this in there because actually the English country house is alive and well. The only problem is that the people living in it are Russians. And this is Mr. Usmanov, who apparently made all his money through Rosneft, and he manages to have a pretty nice house out of it all. Pop stars also live in country houses as well. Let me just... Vickery himself was a utilitarian, which means that his social philosophy goes back to, essentially, to Jeremy Bentham. And any utilitarian, if you believe in things that economists in their other moments will believe, that the marginal utility of income is diminishing, you can make a pretty simple utilitarian case for redistributive taxation. But I thought I would go out and sort of ask philosopher friends of mine what they thought should be the justification for progressive taxation. Why should society justify? The first philosopher I talked to he described himself as a telic philosopher in this regard. He liked evenness of income distribution just as a preference. He felt that if society should be organized in any way, then the society should be organized about a principle of equal income. That's okay, except the problem with an equal distribution of income is that somebody who purely likes this kind of telic ranking will actually prefer a situation where Max and I both have 15. I'm going to prefer that to a situation where I have 20 and Max has 25, which most people would think is a kind of questionable assumption. However, there is a growing within economics, a sort of large and aggressive field of economics called happiness economics. And one thing that happiness economists go out is they actually ask people what they like about things. Some of the consequences are kind of frightening. One of the results that come out of it is that human nature is full of what the Germans like to call Schadenfreude. We like to see people miserable. And one of the things we found out was that a 10% I would regard a 10% increase in my income with exactly the same degree of satisfaction as I would see a 10% reduction in Max's income, which is a kind of frightening and somewhat dog-in-the-mangerish attitude with respect to income. David Blanchflower put it this way. He said, I'll get a lot of extra happiness out of owning a BMW as long as my neighbor doesn't also own a BMW, in which case it turns out, get nothing out of it. So leveling down, unfortunately, might be something that we live by. From an economics point of view, a lot of economics work in the 70s and early 80s revolved around the work of this man and his so-called deontological approaches. Rawls was a sort of moral philosopher, and he posed this question. He said, when we talk about what kind of world we would like to be born into, he asks us to go back, sort of not quite to the womb, but very nearly. And we're about to emerge into the world, and we're behind something he liked to call a veil of ignorance. And the question then was, if I don't know what kind of world I want to be born in, what kind of rules do I think should be established for this world? And he established something that's come down to be known as the maxi-min principle. And the maxi-min principle says, I would want to be born into a society where every institution would be directed towards the well-being of the worst off member of that society. So it's potentially highly redistributive. If I can show that by redistributing income in favor of wealthy people, say capitalists, I will raise all boats and raise the well-being of even the least off person, then that would be an acceptable sort of thing. But generally speaking, all of society's attention should be directed towards the well-being of the least well-off. And, for those of you who want to know how economists dealt with this, they decided that this meant that indifference curves, you remember those, Alexandra? Yeah, good. That indifference curves would in fact be would be right-angled, because only the well-being of either one of the two members of society would be. Rawls came under a lot of attack, but I think Rawls's work at the time showed that everybody was, as we move through the 1960s, concerned about the welfare of the least well-off. You can attack it because you can pose the veil of ignorance question that Rawls posed, and you can come up with different answers. I mean, I might come up with the answer, not that I wanted every resource of society to be directed towards the least well-off person. I might just say, I want to be sure I'm born into a world where there's a decent safety net, and where we don't leave such people out on the street, but, we still allow for rewards for initiative and invention and so on and so forth elsewhere. So you can criticize Rawls. Turning again to Bentham. Max tells me you've got a joint program with UCL. Fortunately, this man who founded UCL is kept pretty much locked up these days. And that's Jeremy Bentham, who founded the utilitarian school, the greatest happiness of the greatest number. When he died, he bequeathed his body to UCL. And it used to be permanently on display in a corridor. That is his pickled head beneath his feet, by the way. I find it ironic that he was talking about the greatest happiness of the greatest number, because I can't think that brought much happiness to anybody. They lock it up now. They only let it out once a year. But Bentham was very, very important in introducing this idea that redistribution was potentially powerful, because if poor people had higher marginal utilities of income than rich people, you can make people better off by changing from rich to poor. And his work was followed by this guy, Francis Edgeworth, who worked in the second half of the 19th century and was very, very much, wrote extensively on public finance, but was of a very redistributive frame of mind, and essentially put forward policies that said, we should move as much from rich to poor, and in fact everybody should sort of average out at a sort of 50% level of income, and we should always be moving in that direction. What he didn't consider was what economists have given a lot more thought to subsequently, was the disincentive effect. If I'm going to have a large part of my income taken off me and given away to a poor person, well, aren't I going to reduce my effort? And isn't social product going to be declining as a result of that? Edgeworth pretty much skipped that one by, perhaps because he got his money. He was an Oxford professor, but he got his money from being an absentee landlord in Ireland, and perhaps didn't see much in terms of incentive and reinvestment as really pertaining to him. I've got an odd collection of people here. Another reason, moving past the utilitarian, another reason for progressive taxation is what I like to call the Willie Sutton reason. Willie Sutton was an American bank robber, and there you see him. He's been arrested in the Eastern State Penitentiary in Pennsylvania. He was asked why he robbed banks, and he replied, because that's where the money is. And one reason for progressive taxation is that if you have high tax rates on wealthy people, that is where the money is, and you can raise quite a lot of cash out of that. There's another obvious reason for redistribution that I think was very powerful in parliamentary societies in the 20th century and at other times, which is that if you have electoral politics, one way of getting yourself elected, if you have universal suffrage, is by enacting policies that tax the few and give to the many, and I think a large part of the redistribution thing. Sometimes it can take an extreme form, as it did in America, for example, in the 1960s. At the end of the 1960s, there was a lot of urban unrest in the United States, and the response to that urban unrest was something called the Great Society Program, which said the way to solve social disturbances, the way to exercise social control was what was essentially going to be the gilded ghetto. As far as I can tell, progressivity had a pretty good ride up until the end of the 1960s. And then it began to run into a variety of crosswinds. The first of them, because you see this, what's happening here, as we enter the 60s, the marginal rates are going to come down, and they keep coming down from the middle of the 1960s to the end of the so-called Reagan Revolution, towards the end of the 1980s. And I asked myself, well, why was this? This man has got a lot to be responsible for. This is Jim Mirrlees, a Scot, and a lot of good economists are Scots. I noticed in your office you have a picture of two Scots, David Ricardo and Adam Smith. Well, Jim Mirrlees is in that tradition. And Jim Mirrlees asked the question, well, instead of just sort of looking at one particular tax and talking about its progressivity, let's turn the problem on its head and say we've got to raise a certain amount of money. And what is the way that it would inflict least in the way of disincentives and distortion on the economy if I address the problem from the other end? And so was born, in some ways, the so-called theory of optimal taxation, which can be seen as a progression. Michael Boskin wrote an article called, From Edgeworth to Vickery to Mirrlees, because that was the sort of progression. Mirrlees did very, very good work, and it's interesting what he said about his own work. He said, I had expected that the rigorous analysis of income taxation would provide an argument for higher tax rates. In fact, it has not done so. Indeed, what attracted a lot of attention about Mirrlees' work really was that you could tolerate relatively high marginal taxes. Some people thought that the optimal rate was about 40%, but it would not go on rising. And in fact, some people extending his work have suggested the optimal tax rate should actually decline when you go past a particular point. And this is because the disincentive effects on the wealth creators, the rainmakers, call you what you will, gets higher with the marginal tax rate. And so by extension, if you lower the marginal tax rate on them, they will continue to be incentivized, and because they're the most productive members of society, this will keep the social pie growing. And that was what the argument was. Some people have even suggested at the limit, the marginal tax rate at the very upper limit should be zero. They can get quite a lot of people like this. Rich people like that kind of conclusion, I must admit. There was also a kind of philosophical countercharge at that time. This man, Robert Nozick, hated utilitarianism with a deep and abiding passion, wrote a book called Anarchy, State and Utopia, and was, if you like, the beginning of what to my mind is a disturbing trend, but still a strong trend, that is very much in defense of the idea that one is entitled to one's property and no one should take it away, no matter how you came by it, or no matter to what social purpose it's put. In his book, Anarchy, State and Utopia, which was 1974, he wrote, our main conclusion about the state are that a minimal state, limited to narrow functions of protection against force, theft, fraud, the enforcement of contracts and so on is justified, but that any more extensive state will violate a person's right not to be forced to do certain things, and that is of itself unjustified. The minimal state is inspiring as well as right. So what's being suggested there, obviously, is that taxation is theft, progressive taxation is progressive theft, and redistribution requires progressive taxation and therefore is of itself theft. Nozick, as you see, looks pretty pleased with himself. And he attracted a certain amount of followers, and his basic ideas have become very much associated with the libertarian right in the United States. And although most of the members of the Tea Party in the United States wouldn't recognize the name Robert Nozick, their philosophy is in fact a direct descendant from it. The third person who started affecting the consensus with respect to progressivity in the 1970s was this man, Arthur Laffer. At the time, he was actually this interesting and oxymoronic character because he was actually on a postdoctoral fellowship at the time when he hadn't finished his PhD, which gives him a certain interestingly controversial thing. But he's very famous because he actually had dinner in Washington one evening in colleague with a journalist friend called Jude Winniski. And the people he went out to dinner with were called Dick Cheney and Donald Rumsfeld. You know those names because they brought you other things later in life, like the Iraq War, but at the time they were concerned with taxation. And he drew famously on his napkin what has become known as the Laffer curve, which is that thing behind you. And the basic logic, it's the foundation stone of what became known as supply-side economics, and it says you can, in fact, collect the same level of taxation at each of two levels. And maybe if I look at the diagram a bit better, that's the same Laffer curve diagram. Obviously, when the tax rate's 0, you don't get any revenue. When the tax rate's 100%, you don't get any revenue because nobody's going to do any work if they have to hand over all of their money. At somewhere between the two, we know taxes are positive. And Laffer decided that it meant that curve, that function was smooth, evenly spaced, and looked like that. And he then further said that basically you have an optimal maximum revenue point, which is marked as T star on that diagram, and that if you were on the upside, you could in fact slash taxes and end up with the same amount of revenue because the incentive effects of the slashed taxes on the economy would be so enormous that the economy would grow, and the growth in the economy would make up for the lower tax rates because your tax base would have been so enhanced. Rumsfeld and Cheney went back to their boss, Reagan, and they said, we met this really smart guy in a restaurant and he told us all about tax policy. And Reagan said, oh, that's great, I think I will cut tax rates by 25%. And so he took tax rates by 25% and tax revenues went down by 25%. And made America very quickly from a creditor nation into a debtor nation and all of these kind of things. Somebody remarked to me the other day that Ronald Reagan tripled the American deficit and required 16 increases in the debt limit and is still regarded as a hero. Barack Obama's halved the deficit and is compared to Adolf Hitler. And such are the vagaries of American politics. But anyway, this became very important. So the three things that are kind of working against progressive taxation was you've got this idea, even among economists, that there is some problem with progressivity because of the disincentive effects. You've got this sort of libertarian philosophical revolution, and you've got these supply-side economists who believe that the way that economics had been run from 1945, from the end of the war onwards, was deeply flawed. And they had something going for them, because at the same time, not many in this room were around in the 1970s, but Nikolai, Susan, and I were. And so one thing that the 70s were distinguished by was very, very high rates of inflation. In fact, we had to invent a new word, stagflation, to describe what was going on in the 1970s, which was essentially zero economic growth and high rates of inflation. And And that led to a great deal of unhappiness with what had been standard Keynesian economics. The problem Keynes had encountered in the 1930s was one of an economy that was held in recession by an absence of demand. So his book, The General Theory, was directed to demand management, and everybody had more or less accepted that the problem in economics was the management of demand. In the 1970s, things came home to roost because demand management wasn't really the problem, and a lot of people saw it in terms of the extension of supply. And that's what sort of happened at that time. Of course, that gave birth to one of the great love affairs of the 21st century. That was Ronald Reagan and Margaret Thatcher, who were the great proponents of lower taxes and much lower rates of taxation and a much curtailed level of redistribution. And I keep coming back to this slide, and it stops me having to go back to the beginning, but now you can see what happens as in the United States we go through the Thatcher and the Reagan revolution. We see that the marginal tax rate, which in the early 1960s had been as high as 90%, is now down around at 30%. And that's a problem. It went up a little bit after that. Some of you might remember the name of George Bush's father. He was a president too, and he got himself elected by staring into the camera and saying, "Read my lips, no new taxes." Well, that sort of blip up in the tax rate is him going back on his promise, and as a result, he was a one-term president. Then you did get a rapid increase in the economy, a rapid growth of the economy in the 1990s. Which you can interpret in various ways. It was obviously the beginning of a surge in productivity that had a lot to do with computerization and the digital revolution. Some of you might want to view it as a kind of delayed Keynesian experiment, that Ronald Reagan didn't so much act on the supply side, but by slashing taxes, fed demand like crazy. And in fact, the demand actually pushed up the economy during the 1990s. But that's for macroeconomists. Okay. One thing that didn't change, and is a constant whenever people look at public finance, is that if you look at any government's budget, the amount of transfer payments are growing all the time. The amount of people who rely on the government for income and the extent of income that they get from the government is just going up and up and up all the time. There are reasons for this. Our populations are aging is one reason for it. Another reason is we are impoverishing sections of our economy. I don't want to, I know tragically little about the Russian distribution of income and finance. This is America, and it's a very, very oft repeated graph. It's the share of income that is possessed by the top 1%. And you'll see in the 1960s and spreading into the 1970s, the height of progressivity, the height of high taxes, if you like, and a little bit after, you'll see that the top 1% of the income distribution had only essentially 10% of the total income. I say only because that on some measures is a lot. If you're a dyed-in-the-wool egalitarian, the fact that there are people who are 10 times as wealthy as the average is somewhat offensive to you. But nevertheless, see what's happened since. See what's happened as we've moved through Reaganism, as we move through the Clinton years, a Democratic administration. But one thing that happened as a result of the digital revolution was people who had been tinkering around with electrical stuff in their garage suddenly found themselves multi-billionaires, and you can start looking at, Hewlett-Packard, Bill Gates, a variety of other people who emerge very much on the top end of the income scale. This only takes the figures up to 2010. It's got worse since then. The top 1% of the income distribution has been getting more and more and more. And I think it's back up now in excess of 25%. And there are some studies where you can get down, you can make a sort of list of 400 names, and they've got a substantial share of total income. So the skewness of the income distribution is getting very important. Notice the last time the income distribution got to those levels, and that was 1929. What happened in 1929? Well, we know what happened in 1929. All the wheels fell off the world economy bus, and we went through the worst global recession ever during the period 1930 through until essentially the only thing that got us out of it was we had the bad sense to declare a world war. When you declare a world war, the recession is over. And that's pretty much what happened during that time. So just keep that at the back of your minds and ask yourselves what happened after the income got this extremely distributed. And I'll try and come back to that. This, again, for the United States, is a matter of the tax shares paid by the various groups. These are total taxes because, as we'll see in a minute, one of the oddities of the American tax system is if we look strictly at income tax, then half the people in the United States pay no tax at all. That's partly because there are other taxes, and although the income tax in the United States is quite progressive in its incidence, it's made up for by other taxes that fall proportionately much more heavily on poor people. And so when you look at that, the red line is the share of total income, and the blue line is the share of total taxes. So if you take the bottom row, the top 1%, you'll see that the top 1% at this time is getting around 21% of total income and is paying 21.6% of the total taxes. So overall, there's not much regressivity there. These are the very wealthiest people in the United States, and they pay just about a fixed share of their income in taxes. And the same can be said if you go back the various sort of deciles going down. So the overall effect of the tax system is not very progressive. So what were those progressive rates that I showed you at the beginning of it? Well, they're the table rates. There are lots of complicated deductions in the American tax system. If I brought in the American tax code printed on paper, it would be like this. And this tells us where the money comes from in various different economies. Okay? Blue is Russia. Finally got you into the conversation. Red is the United States. Green is the United Kingdom. Notice that for all three countries, the national insurance tax, in America, the Social Security tax, in Russia, I think it's just called the payroll tax, I don't know, help me out, is very substantial. Notice in the United States, of the total amount of money, this is to the federal government, this isn't all governmental levels. There's no federal sales tax in the United States. There's no VAT or anything like that. So most of the money comes from the income tax, 45% of the revenues come from that, but 35% come from a payroll tax. Now, the payroll tax in the United States is viciously regressive. It taxes at a constant rate, essentially of 15%, up until you have an income of $115,000 when it goes to zero. So, I mean, the sad truth is, that I, Bill Gates, Warren Buffett, no matter what company you want to put me in, we all pay literally the same dollar amount in Social Security taxes. And that means that 35% of the total tax revenue is coming from a tax source that is very, very regressive. In Russia, you have a payroll tax, 20% just about of federal government revenues is coming from that. Russia, you rely much more on customs duties, the taxes that people pay when the goods cross the borders, and minerals taxes. Obviously, Russia is a very wealthy place in terms of extractive industries, and a lot of the finance comes out of mineral taxes. But when we're looking at the United States, the real reason why there is no progressivity in the tax rates is that an allegedly progressive income tax is almost entirely wiped out by a very regressive social security tax that does away with it. The third one there, corporation tax, is interesting because American businessmen whine incessantly about the heavy rate of corporation tax in the United States. It's actually lighter than in most countries. And if I went back to the immediate post-war period, that profits tax, the corporation tax, which is now raising 5% of revenue, used to raise about 25% of revenue. So capital is being taxed at a much lower rate than it used to be. And whatever progressivity there is in the income tax is wiped out by the regressivity in the social security taxes. From an American point of view, the other taxes really don't add up to very much, okay? In Russia and the UK, some federal government revenue comes from a VAT, a value-added tax, about the same in both countries. Notice nothing comes in the United States in any form of sales tax. Now, this set me thinking, because I'm going back to Vickery, and I'm thinking, he's writing this book in 1947, he's talking all the time about income tax rates, why isn't he worrying himself about social security taxes as being an overall part of the system? Well, because when he was writing, at the end of the 1940s, the social security tax rate, and you've got to believe it, see it to believe it, was 2%. So he's actually not exercising his brain very much about a tax that occupies only 2% of income. Social security taxes were very, very low. The social security system, why you notice now that it's up to over 15%. What's the reason? Part of the reason was because the people who started the social security system were just lousy actuarialists. They had no idea what life expectancy was. And then it's been made worse in America by Americans giving up smoking and all these kind of things. Because what's happened now is that, the life expectancy in the United States has gone up and up and up. And life expectancy of a woman in the United States now is, I think, in excess of 85, and for a man is about 79. So these mean, and once upon a time, when everybody smoked and ate a fatty diet and was very unhealthy, you'd spend 65 years working, you'd go on Social Security for 2 years and die. And that was bad for you, but good for public finance. Now these people live, and the burden is increasing. And the other thing that's happening is that as the number of people living in old age gets bigger and bigger and bigger, the dependency ratio, the number of people in work that they can rely on to pay taxes, is getting relatively smaller and smaller and smaller. So you end up with this situation here of the regressive end of the tax system is going up and up and up all the time. The rates are, and that's making the whole system somewhat regressive. So I asked you when I showed you that income distribution, I said, remember this because we're coming back to it. Because what's happened in the United States is that it is true that the share of tax paid by the very wealthy is increasing all the time as a matter of total tax revenue. But the reason behind that is that they're getting more and more of the money. That we can go back to this is the reason why the tax burden falls on the wealthy. It's not because the tax rates are high, it's because they've got so much of the money. And that becomes a problem. And I asked myself, well, when did this happen before? And the answer was it happened in the 1920s. We had the same kind of thing, although in a bit more compacted time period. We saw the marginal tax rate falling from very high rates, from 60% down to 25%. Remember, in the 30 years I've been talking about here, it's fallen from about 90% down to 30%. And then you see the other two lines, the ones that are starting low and rising, are the tax share and the tax paid in billions. And what's happening is although the marginal rate of taxation, the highest level that we impose upon rich people to pay tax, has been going down to less than half its previous value, the tax share paid by the rich people has been going up. And this is what happened in the 1920s. So both the tax paid and the share of total tax paid by those with income over 100,000. Now, I know what you're going to say is 100,000 when, because obviously inflation can play hell with this. But in fact, I was surprised to find this. The rate of inflation, the average rate of inflation over the 1920s was conveniently zero. So 100,000 at the beginning of the 1920s was pretty much the same as 100,000 income at the end of the 1920s. So we can make this comparison with a certain amount of certitude. And what's happening is the rate's going down and the amount of taxes paid by the wealthiest is going up. And the reason for this is, well, the pie is sort of growing, but it's not growing. That's not what's really doing it. You know, the 1920s are the era of the Great Gatsby. They are the era of excessive skewness of income. And they are the era of excessive consumption. And so what's happening during this period of time is the same as we're getting, which is the income of the wealthy goes up and up and up all the time. And although we tax them at a lower rate, the fact that they are grabbing more and more and more of the total pie means that they are paying more and more of the taxes. And this is a difficult situation to resolve ourselves out of, because, you know, I might come in and say, I'm in favor of more aggressive taxation. I want to raise the marginal rate on the rich. And the rich turn to me and say, but we're already paying over 50% of the taxes. You know, the top 5% is certainly accounting for well over 50% of the taxes. So how dare you come and impose an extra burden upon me? One thing that was very persuasive that kept people from saying, raise the rate of tax on the rich, is this belief that the low rate of tax on the wealthiest, on the high productivity people, on the rainmakers, or call them what you like, in fact encourages economic growth. This is a diagram that's taken out of an earlier paper by Piketty, and it plots the changes in the top rate of taxes and what's happened to the growth rate over about a third of a century, over a 33-year period. And it's interesting. So if you go to the left column over there, you see that the United Kingdom and Portugal and the United States have lowered the rate of tax on the top people by somewhere between 35 and 40%. Germany, on the other hand, Spain, Switzerland, they haven't changed the rate of tax on the top people at all during that period of time. Now, if lowering the rate on high-income earners encouraged high-income earners and gave them extra incentive, you would think that growth in the economies where the tax rate had been lowered on the rich would in fact be faster than the growth rate in the economies where no relief had been given in terms of marginal rate to the rich. And as you see, there's absolutely no correlation anywhere. It's dead flat. Basically, Germany didn't change taxes, grew at 2.25%. Britain slashed taxes, grew at 2.25%. Obviously, there's lots of different stories you could tell there about the other things that were going on in the economy. But, you know, it's not really satisfactorily demonstrated that lower taxes lead to higher economic growth, which is one thing that encourages me to do it. The great outlier there, of course, is Ireland. If we replotted this now, unfortunately, Ireland would have fallen well back into the pack.
Can I just...
Yeah, sure.
Sorry for interrupting. Actually, a friend of mine, he once, about 2 years ago, he read some book on tax collection in the Roman Empire, and apparently Caesars, they had quite a big problem in Spain collecting taxes. So, and well, in modern day Spain would be like the Iberian Peninsula. So, I mean, if you regard Spain there as an outlier in terms of like, it's a, well, high, probably zero tax rate or no change in the tax rate.
No change in the tax rate.
Because anyway, I mean, they probably do not collect it properly. So, and then you regard the island as an outlier, then you have like mildly positive effect, right? So that's...
Oh, you think if I cross Spain out and I continue to count Ireland?
No, you cross both islands out.
I want to cross Ireland out because there's special things going on there.
Right.
Cross Spain out. Yeah.
It's like mildly.
Yeah, I suppose. Yeah.
Positive relationship.
It's a problem with any econometric study when you've got about 16 variables. You throw out a couple of, you can change the slope whichever way you want it. But it is interesting. It's a good thing, right?
Sorry.
It's all right. So anyway, I was anticipating that. And so anyway, there was actually a study done by a man called Hungerford. He worked for the Congressional Budget Office, which is the allegedly bipartisan economic analysis unit that is attached to the US Congress. And Hungerford did a study about tax rates in the United States and growth rates in the United States over a 65-year period. And this is what he suggests. The results of the analysis suggest that changes over the last 65 years in the top marginal tax rate and top capital gains tax rate, remember that they are almost always coming down because we entered the post-war period very high rates of marginal tax. And the top capital gains tax did not appear correlated in any way with economic growth. The reduction in the top tax rates appears to be uncorrelated with saving, investment, with productivity growth. The top tax rates appear, in fact, to have little or no relation to the size of the economic pie. Now, that's one country, that's one study. Maxim will tell me that he's got a friend and he reverse. I don't know. I mean, obviously, the interesting thing about this study, by the way, was that I have a copy because I got it straight off the lines. For a while, it went into embargo because the Republican members of Congress were so outraged at this conclusion that in America, the home of the free, the land of the brave, they decided that this could no longer be distributed because it contained noxious information, and it was suppressed for a period of time, and that's kind of interesting in and of itself. So back to Russia, okay? Russia is planning on bringing in a new tax rate of 30%, so it would go up, it would skip out the 20% step of the old 2000 rates, and it would be imposed at a constant rate of 30% above everybody with an income of 12 million rubles a year. Now, Nikolai's quickly taught me to divide by 40. And so I think that means, in dollar terms, that would mean imposing a constant fixed tax over about $300,000 in American terms, which makes it no more comprehensible to you, but at least it makes it more comprehensible to me. So it's a tax that's levied. I mean, it jumps from 13% to 30%. It's levied on a fairly high income level. And in terms of individuals, I don't know what the density of individuals with incomes over 300,000 is. Because what I do know of the Russian distribution of income, it does seem to be somewhat skewed towards upper ends. And so I'm not quite sure how many people would actually be exposed to this tax. I did do a little more reading. When you read, one of the advantages when it was first put into effect of the Russian flat tax was meant to be it would really reduce tax evasion and tax avoidance. Evasion's the criminal one, avoidance is the okay one. In other words, that people would change their behavior to perhaps not realize income, roll it into longer-term capital gains, or they would take their money outside of the country to evade the tax. The conclusion of this study that I saw, which was actually done at the University of Chicago, came to the conclusion that the lowering of the tax rate, the doing away with the old progressive structure of 2000 into the single flat tax of 13% in 2001 did not have a pronounced effect on tax compliance. In other words, if you were lowering the tax in the belief that everybody would say, well, I wasn't going to pay tax at 30%, but now it's only 13, I'm going to, the effect of that was apparently relatively limited. And that's all I've got to say today. It's a presentation. I knew I was going to have a mixed audience, so I tried to economize on a lot of the technical stuff, and I hope I've done that. But if anybody's got any questions or things that they want to say, or if anybody wants to educate me a little bit more about the Russian tax system, I would only be too happy for that kind of comment. So it's up to you.
Well, let me just to break ice, right? Yeah,
Okay, you always need one of those in your pocket,
yeah,
right?
Yeah. I mean, it's not technical at all.
Right.
I wanted to comment on a couple of slides. So
right.
One slide just.
Oh, do you want me to go back to the slides?
Yeah, I mean the one with Madam Thatcher and Reagan.
Oh, the one where they're sitting on the sofa?
Yeah, I mean, I think you need Gorbachev there as well, because what he did, I mean, he wasn't actually thinking about income taxation, but he actually borrowed from those two people the idea of sales tax. Because when Gorbachev introduced sales tax in 1985 and 1986, the idea was born in conversation with those people. So we were affected by the. Well,
that's funny because he must have had Alzheimer's at that time because he didn't have a sales tax.
No, I know, but I mean at least the whole idea of using and thinking about the tax system. So that was.
But isn't that a more European thing? I mean, if you look at almost every EU member country, they are the ones in which the value-added tax seems to have the greatest share.
Right, but I think he actually, as far as he goes, I think he was convinced finally on the necessity of introducing sales tax was by the Japan Prime Minister.
Okay.
Yeah, but this is one thing. Another thing...
So it's a great regret. American presidents would love to have a sales tax, but it's one of those things... If you read the American Constitution, it's by no means clear that that's what the Constitution says. But over time, the precedent says that the taxing of a general sales tax cannot be approached by the federal government, and the income tax only can be. The federal government does levy some special sales taxes, which are totally puzzling. Like you go and buy a new set of tires for your car. For some reason, that's subject to a federal sales tax, whereas almost any other good isn't. But then
I thought, in the states, certain states they have sales tax, which is collected not by the federal government, but by the states.
Yeah, and it varies from state to state, and therefore it varies in terms of its regressivity. In some states, the tax is levied on everything, including food. Which makes it very regressive. In some states, it's levied only on non-food items, and in some states, it's non-food items, but also excludes things like children's clothing and things like that. So there are different degrees of regressivity of the state tax, but you're quite right.
Another thing that I found it funny what you said about the Piketty's book, because literally on Monday I was in the bookstore in London and I looked at the Piketty's book and I thought I really want to have it, but on the other hand I said to myself probably I wouldn't read it anyway because I read
which is 580 pages or something. It's a commitment.
But then there was a fantastic review by Branko Milanovic in Journal of Economic Literature, so I basically read that review. It covers all the main points, and after that you don't need to.
Why? Right. No, and it's interesting because the right wing, particularly in America, has really been harsh on that book and accuses him of making up figures and all sorts of stuff. But I think it was very, very timely and very good in that regard.
Yeah, but I have a serious question. Actually.
Okay.
Basically, when you were talking about deriving reasons, it's more technical in a way. me, like, deriving reasons on progressivity of taxation from the preferences from like basically utility function. I wondered, I'm not very knowledgeable of how it's done in the theory of taxation. Don't you have something like similar to like, because my area is asset pricing, right? And when the CAPM model was tested and was compared to the data, basically it was found that it's not particularly fitting well the data because the utility function is wrong. I mean, it's one of the view, and then basically you have to throw away the traditional preferences, come up with all this ecological mania panics, and well, basically Robert Schiller, he basically plugged that gap in theory. So I wondered maybe like if you base, is it kind of right to derive any reasons for progressivity of taxation on traditional utility function maximization like mechanism, or maybe do you have any kind of alternative to that? So.
Not specifically. Saez, who's a frequent author with Piketty, he's derived a whole system that's based on labor supply elasticities. Okay. And it mirrors in some ways the Ramsey rule work that was done back in the 1920s, which essentially, you know, the taxes should be inversely related to the elasticities, and that will narrow distortion and reduce excess burden.
Okay.
Okay, but beyond that, I don't know.
Okay, yeah, fair enough. Thank you. Anyway, so more questions?
Yes.
Could you talk a little bit about strategies to avoid progressive taxes? I just think about all these cases, like during last year when some US citizens decided to revoke their citizenship in order to escape, you know, progressive taxes. Or about like a famous example of Gerald Depardieu.
Indeed, right.
Yeah, he decided to.
He's an honorary Russian citizen. Mr. Putin welcomed him with open arms,
yes.
right.
So what do you think about this trend?
Well, I mean,
high in the current years, or?
well, there's, I mean, obviously, one of the problems that Vickery didn't have to think about, and whether he was taxing wealth or whether he was taxing income, was at the end of the war, it was a lot more difficult to move money from place to place. And the problem is not so much the Gerard Depardieu who said, Hollande wants to take 70%, Putin only wants 13%, I'm off. And that's exactly what he did. I don't know if he's still here. Do you know? He is, okay. Anyway, no, but I wonder if he'll go back if Hollande drops his down to 40% and Putin puts us up to 30%. It's interesting. But no, the problem is not those, really, the people who you know what they're doing and you can keep an eye on their assets. The real problem is how you move people, how people move their assets and their income-producing assets in ways that are very difficult for tax authorities to find out. You know, I mean, it's commonplace. You know, a rich individual can afford a much better tax lawyer than the federal government, and that's a fact out of life. And you know, he's in asset pricing, but there are in the United States. I mean, it's a scandal, but it's true. Wealth management companies that do nothing but think up inventive tax strategies that rely on a particular loophole. And so the authorities are going, given the fact that the world is a whole lot more mobile now, then it introduces problems. Can you have progressivity in one country? And I think the answer to your question is what happened in France. Hollande gets elected. He says, okay, I'm going to soak the rich. And the rich say, not us, we're gone. And it's not just Gerard Depardieu, because I was in southwest France this summer. And a person there was telling me that it used to be that rich individuals from that region would go to Morocco for the winter, just for the weather. And then it turned out that with not staying much longer. They could make themselves tax domiciled in Morocco with considerable tax advantages. So, and we've seen this. One of the reasons why there's huge pressure on corporation taxes all over the world is corporations are notoriously footloose, and they will just move to wherever it's been. And one of the reasons why Ireland was that outgrowth is because Ireland became a corporate tax haven. And so growth in Ireland went up. They're about to close that door. Growth will go down even lower. But individuals are now much more mobile than they used to be. And it's true, people are repudiating their American tax citizenship. America is peculiar in this regard because most countries don't make a claim to your global income. I'm a citizen of the UK and of the US, okay? The UK tax authorities are much easier to deal with because they say, did you make any money in the UK? I say no. They say you don't have to pay taxes. If I go to the US tax authorities, they say, did you make any money anywhere? And I can say, yes, I made it in the UK, but I paid taxes. They say, doesn't matter. We want to see all your income, all your taxes. They'll credit me taxes I paid in the US against United States taxes, but they want to know everything. And so in some ways, American tax authorities are potentially more invasive than the tax authorities in most other places. So the mobility, the exit of high-value taxpayers out of the United States is likely to be higher in a lot of other countries. But it's a good question. Thank you. Yes?
You briefly mentioned an idea to tax people not by the amount of money they make.
Yeah.
Not based on the amount of money they make, but based on the amount of money they spend.
Yeah.
Did anybody really try implementing that ever? Maybe there were some experiments, I don't know. Maybe
no, there are. Well, two answers. Some people say we don't need to because as long as you're located in one country, a value-added tax does a pretty good route to taxing your spending. It's not an income taxation or an aggregate spending tax, but it does tax your spending. But by definition, it can't be progressive. Vickery went to his grave, almost. He tried to explain again and again. People said, oh, it's much too difficult to go through life adding up. Because he not only wanted to tax spending, he wanted to tax spending in a cumulative way. So if you spent a lot one year and didn't spend a lot the next year and spent nothing at all the year after, your taxation would be the same as if you spent equally, which he saw as being horizontally equitable. People would just say, no, taxing expenditure is too difficult because we've got to keep an eye on everything that's spending. His answer was, no, it's not, because definitionally, taxation, the amount you spend is the difference between the amount you earn and the amount you deposit in financial institutions. And we keep good records on what people earn, and we keep good records on what people deposit in financial institutions. Therefore, taxation of spending would, to his mind, have been perfectly even. But he could never... He would explain that till he was blue in the face, and people would say, no, it's too difficult. And if you go and look at the agenda, you can almost see him going purple in the face during the pages of that, going, no, it's easy, honestly, And if you read Michael Boskin's paper, which was a memoir, really, of Vickery, he said, I never met Vickery at any conference ever without sometime during the conversation he would say, the answer is cumulative spending averaging, and it was a great love of his life. He was an interesting man. He felt it was almost, this was one thing he did. He was also a great price theorist, and he thought it was everybody's responsibility to respond to price signals. He thought it was irresponsible not to respond to price signals. I can remember once I was going to an AEA conference in Louisiana, not Louisiana, New Orleans. And I'm coming off the plane from New York, where I should be coming off the plane from, and Vickery is coming off the plane from Denver. And I say, Bill, what are you doing coming off the plane from Denver? And he said, oh no, I got this really cheap ticket as long as I went via Denver. Well, I mean, the guy's a tenured professor at Columbia, He's about to win the Nobel Prize with it's got $1 million cash at the end of it. And he still thought it was his responsibility to fly to New Orleans via Denver, which, has all the logic of, It was crazy that way. And then as soon as he won the Nobel Prize, he said, I don't need it. And the first thing he said, one of the interesting things is they always drag people along after they've won the Nobel Prize and say, tell me, why did you win the Nobel Prize? And then they ask another couple of questions. And there'll be some really great ones. I mean, you'll appreciate this. James Tobin, after he won the Nobel Prize, they got him on television and they said he won it for asset theory. And they said, tell me, Professor Tobin, what is the essential genius that led you to win the Nobel Prize? And he said, my theory is that you shouldn't put all of your eggs into one basket. With the result that people all over the world go, he gets $1 million for that, right? Vickery declined to give much of an answer on why he won it. He said, I don't, he said, I've won it, and he said, I don't need the money, he said, but I need the bully pulpit. He saw it just as the Nobel Prize given him the capability to talk in lots of fora about his ideas. And the sad thing is, he died of a heart attack while driving himself from Columbia. He just won $1 million, so he decides to drive overnight from Columbia to Harvard. He'd been invited to give an address at Harvard. He drives overnight, has a heart attack at the steering wheel, and dies. I wish to this day that he'd spent part of his $1 million and got himself a driver or possibly a hotel room. But he was that kind of person. He was, in all his habits, very abstemious. But yeah, to my knowledge, there have been attempts at an aggregate spending tax, and I think there's been one, and it was abandoned, and it's escaped my mind where. But the answer is, did it catch on like a house on fire? No. But you can see why I think it's a good, as we look at a world with diminishing resources, the idea about taxing people to the extent that they use up resources, rather than, which is what spending would do, rather than what they contribute to the pot, which is what income would do, is a more and more attractive idea to me all the time. But do I think it's going to happen? Probably not.
Yeah, actually, I wanted to also point out that this flat rate in Russia, 13%, the one of the deputy ministers of the economy in Russia, he said that his view is actually very mixed about this flat rate, because on the one hand it obviously helped to bring in lots of people from the shadow of the formal economy, so they started paying taxes. On the other hand, because the government allowed free movement of capital, what people started doing, they started earning money and taking capital out of the country and basically depositing it in Europe, the States, elsewhere. Yeah. And so literally this flat rate contributed to the capital outflow that basically harmed the economy for the last 10 years. So.
No, and it is indeed one of the sort of ironies of the world economy, the extent to which personally owned capital has taken flight. And I don't know how it's going to stop. I mean, the United States is in a perpetual war with banks in Switzerland, because banks in Switzerland used to regard anything in a Swiss bank as being priority, and wouldn't divulge it. But now the Swiss banks hand it over now. But if not Switzerland, then the Netherlands, Antilles, or the Cayman Islands, or there's always someone else who's prepared to look after your cash and not tell the tax authorities. So it's going to be an increasing difficulty. Which I think is why, if Maxim had bought Piketty's book and got to the last page, he would have seen that what Piketty's actually calling on is for a global progressive wealth tax. Which is very, very important, but if we couldn't get around to doing a spending tax in one country, I'm not sure how we're going to do a global wealth tax. But obviously, it's one of those things. It's in economics, it's an enormous externality problem, because everybody can agree, but to implement tighter rules, but the rewards to a free rider who isn't implementing the rules are enormous. And that's why I think there's going to be a problem implementing it.
But yeah, I agree, because I think it's, well, the critics of the Piketty's book, this is precisely they were saying. It has, like, the first part of this book is really good at, like, basically grasping the problem, and then as far as suggestions go, and in terms of this global wealth tax, it's not just very difficult to implement, and it's basically not particularly clear at the moment if it's a solution at all in the end. So that's
and because even if you could collect the tax, I mean, my early work was actually on rules for the distribution of government expenditure, which is, even if you can collect the tax, then you've got the secondary question of how you're going to allocate it. And you run into all sorts of problems. But I don't know. Any more questions? Thank you all for being here.
Yeah, thank you.
Thank you, Max, for having me. Okay.